Hello, everyone.
Hello, Renette.
Welcome and Mimi to our webinar. Please let me know if you can hear me.
Yes, I can hear you.
I can also hear you.
Hi, Renette's internet is messing up a bit, so I'll start the conversation while she sorts that out. So, um, Elikem, can you please tell us about yourself? The participants are on the call, and then I think we can start with that.
Okay. Hi, I'm Elikem Agbosu. I'm a fund manager with Data Bank Asset Management. I manage investments for high net worth individuals. I'm fascinated about financial freedom and helping people to get themselves in order in terms of their financial health. So I'm eager to have this conversation. I believe retirement planning is a topic that a lot of people don't think about, especially young people who started working. So it's always a good time to start while we have 20, 30 years ahead of us to have this conversation. So I'm looking forward to it.
Okay, all right. Thank you, Elikem, for that introduction. Can we hear from Mimi?
Hello everyone. Sorry, my voice is not too good. My name is Mimi Anane-Appiah, and I'm currently the team lead for the Investor Education and Advisory Department. Basically, we do what the name says. We educate and then we advise. Retirement planning is basically, I think my major work experience has been in the pensions industry. So retirement planning is something that comes very let me say easy to me, or something that I've seen both from the beginning of people's career to the end and how it plays out. And I can tell that with careful planning and being intentional, achieving a comfortable retirement is something that we can all achieve. And why it's necessary for young people is that we have a resource that we take for granted, which is time. So basically, we want to use this time to talk about how we can leverage on what we have to get what we want. Thank you.
All right, thank you, Mimi, for that introduction. I think Renette is back. Renette, can you hear me?
Yes, I can
Hello,
hear you
Renette,
now.
can you hear me? Okay, all right, sure. So over to you, Renette.
Okay. Hello, everyone. Thank you for joining the webinar. My name is Renette from Betnel FinTech. Today we are discussing how to plan effectively for your retirement. We have two really important people here when it comes to retirement planning. They are going to give us some practical tips to help us plan effectively for our retirement. First, we have Mimi Appiah, who is a financial advisor, and we also have Elikem Agbosu, who is a fund manager at Data Bank Asset Management. So today we're going to have a little discussion on retirement because over the past months we've realized that people don't really understand for retirement for periods and then retire surprised the amount of money that they receive as pensions get all rolling. Maybe sorry, Elikem, what is the relationship between retirement planning and wealth planning?
Okay, so with retirement planning and wealth wealth management or wealth planning, they may seem similar. There's a bit of overlap. It's all about determining how much you will need in future to take care of your needs, and then determining where to put the money so that I can get you the right level of the right amount of return, grow sufficiently, but without taking more than necessary risk. So those are some of the similarities. But it all boils down to where are you investing your money so that you can get your money back when you need it. But there are some key differences that we need to consider. With retirement planning, you would realize that there's usually a target date when you retire, whenever it is you choose to retire. So let's say you want to go by the Ghanaian statutory retirement age of 60. If you are 25, then that means you have 35 years to go. So you will be planning with a 35-year horizon. You have 35 years to work on your retirement plan. Then if you have just 20 years or 15 years, you are 45, you have 15 years to retire, then you have a 15-year time horizon. So you'll be planning appropriately. If you are considering wealth management, then it varies. Some people plan their wealth generally, and all other needs fit in: school fees in future, home expenses, a whole lot of things fitting in there. Some just have a rainy day fund. All that fits in there. So the time horizon is fuzzy, and it varies from person to person. Right. Interesting thing though is even with regards to time, and eventually if you can have these two plans separate, where you have your retirement planning going on one hand and your wealth management planning going on the other hand. Eventually, what I've seen with my clients, the high net worth individuals, is by the time they turn 60, it all merges into one. So they have their provident fund. They look at either getting an annuity or bringing the money, the lump sum that they get from the provident fund, into their wealth management account and run them all together. So eventually they would all merge, if for most people. Another difference is risk. So with risk, with regards to retirement planning, there is a certain level of risk that you should take. I would say low to moderate risk. Low because this is money that, touch wood, you are planning that you should be able to retire. You should be around at 60, so you need the money to be there. And with moderate, it gets moderate because you have a long time horizon, so you can take on some risk. Risky investments are able to have you go in and out of the investments, go to ride the storms, pardon me, to ride the storm. Some, if it's equities, for example, which are known to be risky, what you see is the value of your investments go up and down. So with the long time horizon, if you have 25 and you have 35 years to retire, that gives you enough time for you to ride out all those ups and downs. So that's why I would say low to moderate risk. However, with wealth management, again, it varies. There's so much you can do. Some people are very conservative, so they'll do only treasury bills. There are some people who are aggressive, so they'll buy more shares. Some even, I dare say, crypto, more current foreign currency denominated investments, FX trading. The spectrum is wide, so that's a key difference. Whereas retirement planning is more conservative, wealth management varies from most conservative to high risk taking. Last thing I'll mention is with retirement planning, the focus is narrow. With retirement planning, you are focusing on the target, that's retirement planning. But with wealth management, you are looking at a broad spectrum of investments that you can do to suit those needs. So yeah, those are some of the differences and similarities I would cite. Okay, while we wait for Renette, perhaps I could throw the next question to Mimi. So Mimi, what are the things one should look out for when planning for retirement?
Okay. Yeah, so one of the first things that you should do is be able to set a retirement goal. But before that, as you said, with retirement, normally there's a particular age you're working towards. So it's either you're working towards 60, 55, whatever age you are working towards. Some people like to retire earlier than the formal retirement age. So whatever that age is would help you to plan. So it's good to sit down and have that in mind when you are planning. But once you have that in mind, it's important to set retirement goals. And by retirement goals, I mean you could look at your retirement goal as your retirement income goal or your retirement needs or expenses goal. So, for example, when I did mine, I decided that, okay, I need this amount to be comfortable, for my family to be comfortable. So that is what I use to determine how much, I would need based on my current budget, adjusting for, cost that I would be incurring when I go on retirement, like healthcare costs, because my company would no longer be paying for that. And taking our costs down, no longer be incurring. So doing the adjustments and coming out with a figure. I mean, the younger you are, the more difficult it is for you to arrive at this figure. Because if you had asked me a few years ago, I'll probably have a different figure. But it's good to have something of that sort that becomes something that you work towards. And now there's almighty inflation, so you can't plan without considering the effect of inflation on whatever income goals or your retirement expense needs that you have set. You need to consider inflation. I think in planning for retirement, a lot of us don't consider things like healthcare costs. As I said, your company will no longer be paying for you. We also have long-term care. You get to 80, you can no longer be doing some of the things that you used to do anymore. You need some support that comes at a cost. These are things that you should be planning for. We always pray for long life, but long life also comes with cost implications for our retirement. So if you want to live that long, for me, I use my grandmom as an example. She's 90. So if I'm supposed to live to 90, how am I going to maintain a comfortable retirement? So having all these would help you arrive at, a decent enough retirement goal. Now you know your retirement goal, which is where you're going. Another important thing to know is where you are at the moment. And that is where in financial planning, you will look at your net worth, your assets and your liabilities, because that determines, should you retire, the assets that you can easily liquidate to draw down some income from, and your obligations will always affect, you can have so many assets, but if you have so many liabilities or obligations, the assets that you have may not be able to generate as much because you have obligations. So these are some of the things that you need to look at. You need to look at your retirement prospect. I'm still talking about your current financial situation. So we are looking at the income streams you're looking at when you go on retirement. Where are you at the moment? So in Ghana, a lot of us depend on SNIT at tier 2, at tier 3. So looking at these statements, looking at where you are at the moment, if you should continue that way, are you going to be likely to achieve your retirement goal? If the answer is no, then that is where we need to think about how can we bridge the gap. And so in a nutshell, that's retirement planning. But let me say that retirement planning does not end when you retire, which a lot of people make a mistake with. There's also post-retirement planning. So how do I manage, my lump sum to last me throughout my retirement and to meet whatever needs I have? So I'll say that retirement planning starts from the day you get your first job or earn your first salary till the day you drop dead. That will be a retirement plan. These are some of the things that you can take into consideration.
Thank you, Mimi, for those points. Just picking up on some what you said about your grandmother being 90. Today is a good friend's birthday, and we are wishing him birthday wishes. And we usually say, wishing you long life and prosperity. And like you said, long life comes at a cost. I can see that your family has really wished your grandmother a lot of blessings, and she's reaping them. So it's good to. I hope that everyone else is thinking and putting this in perspective. What if you get to 90? You need to think about inflation, as Mimi said, and how and the kind of cost that you be incurring, especially those that your company was taking care of, or some group was taking care of that you didn't have to worry about. Now you have to worry about it, and you have to think about your income streams, right? So speaking of income streams, we have Emefa Agonyo here with us. Emefa, hi, welcome to the webinar. Can you please introduce yourself, and then we'll head into some questions where there's no other experts than you to answer for us.
Thank you, Elikem, and Mimi, nice meeting you here. It's been a while. I used to meet Mimi a lot when we go out, so it's good seeing you again. My name is Emefa Agonyo. I work with SNIT, and I'm at the Corporate Affairs Department, and basically what I do is to educate our contributors and non-contributors, let's say contributors and prospective contributors on their right to Social Security and what we owe them, the responsibilities we owe them, and what their rights are under the law, the pensions law that is in operation at the moment. So currently that's what I do, and any other job that comes in, you do retirement planning, you do new staff orientation for other organizations, because most companies would want to introduce their new staff into what Social Security is, what they're expected to do, registration and all those things. So those are my core responsibilities as far as Social Security is concerned. I guess I'll leave that there. It's not really about me tonight, it's about what our viewers and our listeners need to know, I guess.
Yes. What our viewers need to know. I found something you said very striking. I've been in the industry for 6 years, but this is the first time I'm hearing that Social Security is a right. Perhaps you can touch on it a bit more into details while you're answering this next question. Right? We are curious. What role does SNIT play in a person's preparation towards retirement? So our audience would really like to know this.
Okay, so thank you for the question. So before I even talk about the role SNIT plays, let me start from our Social Security being our right, because that is the basis for which SNIT is in operation or is in business. So Social Security is a human right Just as you and I have right to association, right to shelter, right to food, that is what Social Security is to us. And Social Security is not limited to persons working in the formal sector, even informal sector persons. Once we are all human beings, we have the right to Social Security. And Social Security is administered across the world. So today, yes, I'm in Ghana. And so maybe I feel like my employer is forcing me to pay contributions into a Social Security fund. Or wherever you find yourself in the world, because Social Security is your human right, wherever you are working, whichever organization that has engaged you, will ensure that you do the needful. Because everybody, irrespective of where you find yourself in the world, you would grow one day. And like Mimi said, we must all have retirement plans to work at. If you don't have the plan, you can't work at it. You need to have a plan to want to achieve. And that's when you put in the work towards it. So that is what Social Security is to everybody. But the laws that govern Social Security differ from country to country. And so that is what I would want to say when it comes to the right issue. And having talked about law, then we would want to know what the role SNIT plays when it comes to planning retirement. SNIT plays a major role. People would want to say we used to, but we still play a major role because some years past, SNIT used to be the only Social Security administrator in the country, but now we have other players. So Mimi's company is on the Elikem, your good self data bank is also on the all helping to manage Social Security in this country. So what do we do? For us, we are mandated under the National Pensions Act 766 to manage the basic national pension scheme. So we register employees, we register the employer and the organization, and we take contributions on behalf of the employees, invest these monies, and we pay benefits as and when people are due. As and when people are due, because we have different types of benefits under the scheme, and people would qualify for these benefits at different times of their lives. So as and when somebody qualifies for, then we pay. But back to the major rule. You have a plan, retirement plan. So I want to retire at probably age 60. That's the compulsory retirement age. So you want to stay on till age 60. However, today you are probably 30 or let's say 28 and you have just gotten employment. SNIT sees to it that you are registered onto the scheme. And at this juncture, I must emphasize that it is the registration that SNIT does for you that gives you access to even make your second tier contributions and third tier contributions, because we give you the number, and based on the number, you're able to do these contributions. Unless, of course, you want to go to a second tier fund manager, a third tier fund manager directly, then they would find a way of handling you. But because under the law, tier 1 and 2 is compulsory, SNIT takes the responsibility of registering the contributor, which is the worker. But sometimes, because not all of us are working with formal organizations and we are working on our own, people come in directly to register on their own as voluntary contributors. But if you're working with organizations, let's say like Mimi's organization or your data bank, for instance, we need to register data bank as an institution with SNIT, and then that allows us to take contributions from data bank on your behalf. In the event you are no more with data bank, that opportunity doesn't cease. SNIT continues to take your contributions once you bring them in. You probably would have left data bank to a different organization, or would have left to start your own business. Whichever way, you still have the responsibility to contribute towards that retirement dream you had and that plan you had already put in place and have started working towards. Once you lose a job in a formal environment or formal sector, it doesn't mean you can't continue your retirement plan. You should be able to continue that. And so one of the responsibilities, aside registering and taking contribution, is to educate the general public. Because for most of us out there, we feel that, oh, I used to work in a formal environment. Now that I'm no more doing my own business, like people will call it, then it is a free money for me. I decide to do it or not. No, you have it as a responsibility to yourself. In this case, if you don't pay those contributions towards your retirement, what it means is that you are denying yourself that right that has been given you under the law. Originally, if your employer wasn't paying, then we would say that your employer is denying you your human rights to Social Security. But in this case, you would be denying yourself. And so we try to engage these people, to educate them, to let them understand the need for social security. Not all of us will have money to do extra investments like you guys have mentioned, but at least the basic one, that SNIT can pay you and what tier 2 can pay you, that we see to it.
That's great. I like how you ended your submission. Not everyone can afford to do an investment beyond this, but this is basic. Everyone needs to get in there. To our audience, if you just joined, we are having a conversation about retirement planning. And if this is the first thing you've heard, I think you can just walk away hearing this. Not everyone can afford an investment, but you have to benefit from your rights. It's a human right. If your employer is not making the contributions on your behalf, they are denying you your rights. At least get this covered for yourself. Okay, let's stick with you, Emefa. So we are talking about these rights. Let's say someone turns 60 under this current regime. How do you calculate the benefits that you'd give the person?
Okay, before we even talk about how to calculate the benefits, I have spoken about registering and paying contributions onto the scheme. So with the SNIT scheme, for instance, before you even turn age 60, which is the compulsory retirement age, and I must be quick to add that the law allows you to come for voluntary retirement if you so desire, what we usually would call the reduced pension, and that starts from age 55 all the way to 59, 11 months. So before you want to think about your benefit, first of all, once you decide to register onto the scheme, the pensions law is available for everybody. But the truth is not everybody will be able to read them, not because they are not literate, because sometimes they don't have the time or they don't even know where to find it, or they might not understand the basic language. I must say that under the SNIT scheme, whatever benefit is paid you is clearly defined in the law. So with the SNIT scheme, we usually would say that your benefit is predetermined. So before, if you want to be as critical as somebody else, you would want to read the law before joining the scheme. Then you know what is in for you. So with the benefits, there are about 5 core benefits we pay under the scheme. So I don't know if I should take them one after the other because they all come in different forms. So first of all, the basic method or the basic way of qualifying for benefits under the scheme is that you should have registered onto the scheme and you've made a minimum contribution of 15 years, or what we call the 180 months in aggregate contributions. 15 years will translate to 180 months. That's the minimum you should make. But you can make up to a maximum of 420 months. That is 35 years, and you could do more than that. It's all dependent on you. Others would start work at 20. People will come in at 25. People will come in at 30. So obviously, we're all going to have different number of months of contributions we have made. But the law is saying that if you don't make the contributions at all to qualify for what is called pension, and pension is the money we pay you monthly when you retire or when you exit from the former work environment, or you exit from work environment. The money we pay you monthly is what we call pension. That is not to say that if you don't make the 180 months, you don't qualify for any benefit. You qualify for other benefit. But like I've said earlier, not all of us can afford to invest in other financial schemes elsewhere, like buying treasury bills, buying government bonds, or maybe doing even tier 3. So it is advisable, or we encourage people to at least do the 180 months of contribution, which then qualifies you benefit for life, because then we are going to be paying you as long as you live, unless, of course, for whatever reason you decide to exit the world after 75 years. Then that one, you have decided to exit. But as long as you live, we pay you benefits, and these benefits are subjected to annual increment as I speak to you. So now let's take the first benefit. That's the old age pension, or the superannuation benefit that people usually would know SNIT for. In fact, when you hear pension issues in this country, even though the Cap 30 scheme is there, once you hear pension, the first thing that comes to mind is SNIT. So that is what people have known us for. Now, before you qualify for the pension benefit or the superannuation benefit, like I said, you should have made a minimum of 180 months of contribution or 15 years of contributions. And like I said, the compulsory retirement age in the country is age 60. However, the law allows you to come in for voluntary retirement. So this pension comes in two forms. Let me focus on the full pension. So full pension, you should have made 15 years of contribution, that's minimum, or above that, and you should have turned age 60. That means that you are coming in for full pension. However, if you make 180 months and above or 15 years and above of contributions and you turn age 55 all the way to 59, 11 months, and you want to come for retirement or come for your benefit, we'll pay you what is called reduced pension. What is the difference between the two? Data Bank, you are into a lot of other investments. So granted that I decide to buy any of these government instruments with you, but let me peg it at 91 days. And Mimi buys same amount, 91 days. But before the 91st day, I come in to say, for whatever reason, I have got my instrument, I have an emergency, I want my money. Remember that at the point of purchase, you promised me an interest amount that would be paid me at the maturity of my instrument. This is the situation. I come in earlier than expected and I want my money. It is my money. You would pay me all right, but the actual interest amount promised me, I will not get the full amount. Why? I didn't wait for the maturity. The moment you register onto the SSNIT scheme, the contract is to expect you to come in at the age where government has declared for everybody to go on retirement. That is age 60. So that you get your full pension. But if you decide to come in at age 55 or anything less than 60, that's when we pay you the reduced pension. So that's the two difference with that particular benefit. Now, with calculating these benefits, there's so many factors that we will look at. But let's look at the three major factors that we usually will look at. The amount you earned as salary. Why do we look at this factor? Remember that contributions are made on your basic salary, what you have declared as basic salary. So the amount you earn as salary is very important. If you earn a bigger salary, obviously your contribution will be big. So it means that your pension will be big. Again, we are looking at the number of months you have contributed. If you've made the minimum of 180 months, which is 15 years, and let's say Mimi on the other side has made 20 years of contributions, obviously the number of years are not the same. And then the major third factor we look at, what age are you coming for retirement? Are you coming for full pension, which is age 60, or you are coming for reduced pension, which start from 55 all the way to 59, 11 months? These are the factors we look at. Having spoken about this, now let's get back to your contribution. You've made contributions for 15 years. For the purposes of this discussion, let's just peg it at 15 years. So you've made contributions for 15 years. We are going to look across the 15 years of contribution. So technically, we are pulling out all your 15 years of contribution or 180 months of contributions. What are we looking out for? Don't we already have the statistics? We do. But we want to find out your best 36 months highest salaries. That is 36 months would be 3 years. For those of us in the public sector or the civil service, most often, the longer we stay on the job, we rise through the ranks. And so then our salary rises. So most of us, usually during the startup of our working life, our salaries are very small. Those of us who find ourselves in that situation. So there are people who have worked like 30 years, 25 years straight in the public sector or the civil service. These people, as they stay longer and they arise on the job, so they get promotions here and there, then the salary increases. So for such people, most often, their best 36 months salary would usually be towards their retirement age. So we'll pick these 36 months salaries and then we add them together. We divide it by 3, we find the average. That average is hanged on the wall. What next do we look out for? How many months of contributions have you made? And like I said, for the purposes of today's webinar, we are pegging it at 15 years, which is the minimum number of years you should have contributed. So now we have found the average of your best 3 years salaries. Now, 15 years, what would it give you? What percentage of that average will it give you as your startup pension? That would give you 37.5% of that basic, so of that average of your best 3 years salaries. Now we want to move on to the age reduction factor. Are you coming in at age 60? For the purposes of this first scenario, let's peg it at age 60. So you are coming in at age 60, full pension. There's nothing like age reduction factor that is going to affect you because you came in at full pension. that's your maturity stage. So nothing is going to affect you. So whatever amount you have made, whatever amount we got out of the best 3 years salaries, which is the average, that 37.5% is going to be your startup pension, subjected to annual increments. So this is December. So let's say I probably retired in November, or probably even in December. If I retired somewhere within the first 2 weeks of December, then I'm likely to get my pension before the end of the month, because technology, we've leveraged technology, and these days it's a minimum of 3 days and a maximum of 2 weeks to pay pension. That is if your statistics are right, you've been checking your statement, there are no missing gaps in your statement, then within 3 days and a maximum of 2 weeks, we are paying you your pension. So that is for full pension. Now, same 15 years, 37.5%, and same average of your best 3 years that was found earlier. However, in this instance, we are not looking at full pension, but you are coming in for reduced pension. So you're probably coming in at age 55 or 56. In that instance, the age reduction factor would affect you because you didn't come in at maturity. So we would work your 37.5% off the average that was found, and at what age are you coming in? What percentage of your pension would be reduced because of the age you are coming in? That would also be applied to you. And what I'm telling you, you can basically just do this on your own. If you if you log on to the SNIT website and look out for the pension calculator or the pension estimator. Once you have these parameters, and how do you get the parameters? It is usually on your SNIT statement. So if you have gotten your SNIT statement before, and we send statements every quarter. So if you've gotten the last quarter statement, your best 3 years will be on there. The average is equally stated on there. You can use that to work out this, and you would be sure what you are getting. Now let's move to the other benefits. So I haven't made 15 years of contributions, but I'm 55 all the way to 60. And I think that even if I wait till 60, I can make 15 years and I want to retire. You can walk in and come for your benefit. What do? We put your contributions together and work an interest on it and pay you. That is a one-time lump sum. That is where the planning for retirement after retirement continues, because this time you are not earning a monthly pension. It's a bulk money, lump sum paid you one time. You would have to now strategize. How are you going to manage this money? Remember that once you're not getting the pension from SNIT and you're getting a lump sum, you are also getting a lump sum from tier 2. And if you are possibly doing tier 3, you are still getting a lump sum from there. You would have to now think through, how do I manage this money? I am probably expecting to live the next 10, 15 years, or my family has this blessing where we live long. Like Mimi said, her grandmother is 90. So granted, her grandmother retired at age 60. She's been alive for 30 years, even after retirement. So a person in that situation would have to plan, how am I going to manage my lump sum that is paid me? Am I going to invest elsewhere? Am I buying annuity elsewhere? These are things you need to think about to inform how you're going to be living even after you have assessed this benefit that has been paid you. We have one benefit that the people usually do not take note of, or they hear about it and they don't take it serious. But trust me, that benefit has no age limit. All of us on the call can qualify for that benefit. That is not to say tomorrow morning, call me and say you're coming for your money. No, there are conditions that qualify you for that. So that benefit is what we call the invalidity benefit. And for that benefit, it goes for people, or it's paid to people who are either physically disabled, or who have been rendered physically incapacitated, or mentally disabled, or anybody who suffers any kind of issue. And a medical doctor can put a pen to paper and say, after running a thorough examination on you, what we have realized is that your situation cannot allow you to work ever again. Remember, I said Social Security is your human right, and it's supposed to cushion us against the future. The unexpected has happened. What do? Do you become a burden on society? No. So what happens once the medical doctor gives you this report that you can't work ever again? Maybe you are not in the right frame of mind to submit that report to the SNIT office. So the family members who are taking care of you are expected to submit the reports to the SNIT office with the SNIT number. I mean, the SNIT number of the person who is suffering whatever medical condition that has been declared, incapacitated. Sometimes they don't even know the person's details, so they can't even find the person's SNIT number. That's fine. Once you come to our office, we can dig out the number. What are we looking out for? We want to see that in the last 36 months, 3 years, if we are backdating 3 years to the date of the incident that you've suffered, can we find 12 months of contributions? So we are backdating your contributions from the very day the report was submitted to us back to the point where you suffered whatever situation it is that has rendered you incapacitated. We are looking for 3 years. And within the 3 years, can we find 12 months of contributions? If we do, you have qualified for the first leg. Now, what is the second leg? SNIT will constitute a medical board. This medical board has medical doctors from the regional hospitals, 2 senior medical doctors from the regional hospitals who are specialties in your situation. Because obviously, you can't bring somebody who has an eye problem, who is virtually rendered, who can't see anymore, visual impairment. You can't bring a doctor, an eye doctor or an ophthalmologist to come and take care of somebody who has a mental issue. It is not possible. So we bring medical doctors who are specialties in your situation. 2 senior most from the regional hospital. It doesn't matter which region you are in Ghana. Once there's a regional hospital, we look for those senior most doctors. Again, we get another senior doctor from the trust hospital. These people are put together. We invite your family to bring you. We run a thorough medical examination on you at the cost of SNIT, not you, the contributor. What are we looking for? A confirmation that indeed what the previous medical doctor wrote about you is true. Then we start processing your benefits. Like I said, this benefit has no age limit. You have qualified for the first point where we found 12 months of contributions in there. Now you have qualified, the medical doctors have confirmed that what was written about you is true or even worse than what was written. We pay you as though you are 60 years and as though you have made 15 years of contributions. I guess I would want to pause here. As we go along, I'll bring in the other benefits so that it doesn't look like Emefa alone is doing the talking.
All right, thank you, Emefa, for that explanation. I have actually enjoyed all that you said and learned so many things. I have 1 or 2 questions to ask as we go on. So, yeah, let's move to Mimi. Mimi, can you share with us some strategies you think a young person can take advantage of in preparation towards retirement? Let's say that you recently started work and you've been on the webinar or you've heard about retirement planning. What can a young person do to prepare for retirement?
Mimi, please unmute.
Sorry.
Yeah, Mimi, I think your mic is unmuted. Okay.
So I was saying that as a young person, the advantage you have is time, because you may not start with a very nice salary. I mean, at least the masses don't start with a very nice salary. So what you have to your advantage is time. Now, it's very important that even though retirement is 35 years, maybe 40 years away, that you start as soon as you earn your first paycheck. And why do we say that? If you start early, you just need to put in a little effort every month. And by the time you retire, you would have so much that you can fall back on. If you wait till it's too late, you need to put in so much more effort. And remember that even though your salary may have increased as you grow, so does your responsibility. Now you have kids you have to take care of, your parents are aging, and all those things come to play. So I'll say that start early, even if it's 50 cedis, 100 cedis, whatever amount that you can be consistent with, be consistent with that. I always also say that also take advantage of the pensions arrangements that have been provided. So either tier 1, I mean all of them, tier 1, tier 2, tier 3. I'm sure Emefa has explained that SNIT is an insurance. So there is something that SNIT provides. They take care of longevity risk, because you don't know when you are going to die. If you haven't planned well enough, you may not have enough money to sustain you during those years that you haven't planned for. But once you contribute to SNIT, they take care of that risk. At least you may not be earning so much, but you can meet your basic needs when you are that old. So I think tier 1 is something that we all should do, and look at how you can optimize it. Tier 2, very important. Also make sure you are doing that. And also the provident fund or personal pension. Now let me say that the way the law has been structured, if you should take advantage of all these 3 schemes, you should be able to replace your income by more than 100%, at least if you are not withdrawing often. So it's been done in such a way that they all complement each other. If you focus on just the mandatory ones without looking at the voluntary ones, yes, you'll be able to replace your income by a decent percentage, but there's still a gap. There will still be a gap. So take advantage of all the platforms provided. And remember that all these schemes allow for you to make pre-tax contributions. So if you are taking advantage of your SNIT, your tier 2, your tier 3, that is 35% of your basic salary that you are able to contribute towards your pensions, meaning less taxes to government. I know we are talking about, these e-taxes and how we don't want to pay, but these are opportunities that are available on the table. So you might as well take advantage of it, so that eventually when you retire, you're doing well. One thing I've noticed is that you can't talk about retirement planning in a vacuum. It fits perfectly into financial planning or wealth management, as you were explaining, Elikem. And the reason being that when an individual just focuses on retirement planning, what they are going to do is there's going to be an emergency. And that's when you hear them call SNIT and say, can't we have some of our money? Or that's when you hear them call and say, oh, my personal pension, can't I have parts? It could be something as small as my tire, I need to replace my tire. But the person has no emergency fund. The person probably is not planning for their children's school fees and all that. So I always advise individuals to have a holistic financial plan. And retirement planning is one of the important things that should be covered under your retirement planning. You should have an insurance. All these things ensure that you are able to optimize your plans towards your retirement. Otherwise, you are going to be withdrawing more than you should. You are going to be calling people who will never give you the money anyway. So make sure that you have a holistic financial plan, so that you are not pressured to take money from places that are meant for long-term goals. As much as you can. This may not be something everybody can do, but if you can, try and make sure that you build your own place, or let me say have a place that you can live, if it's a family house or whatever, as long as it's a comfortable place that you can live. Because I mean, for most of us, when we look at our monthly budgets, we can tell that a good percentage of our budget goes towards rent. And so if you have your own house, of course you pay maintenance and all that, but it may not be as much as rent. If you have your own decent place, let me say decent, small, manageable, because a lot of us end up going for these mansions when our children are gone, and now it becomes an extra cost to you. The rooms are dirty, empty and gathering dust. You can't rent it because of the way you built the house. So try and get something manageable that you and your spouse can manage, and it comes at a lower cost. But if you can't afford to, make sure you are nice to your family members. At least you can go and hide there. But I think housing is one of the major expenses, or one of the major issues. I do see a lot of people wait till it's too late, wait till they are retired. I don't blame anybody. Salary levels are low and sources of financing quite expensive. I don't blame anybody, but waiting till you go on retirement before you sort out your housing needs means that that lump sum that is meant to support what you'll be getting from SNIT, so that you are better able to bridge the retirement income gap. That's what you are using to build a house. And remember that a house, in some cases, especially when it comes to the investment side, is sort of referred to as a liability, because it's going to be incurring more cost for you, not really bringing you value, especially if you are not renting it out. So it may not make sense, for you to put your lump sum into a house that is not generating income for you. It's very important that if you can build a 1-bedroom, 2-bedroom boys quarters and not care about what people think, because that is what lands us in a lot of trouble a lot of times, you'll be surprised how you will enjoy your retirement. Let me end with a story of a client. I have told Elikem about this, who retired with 12 million. Of course, he was earning quite an amount, but he shared his story of how he was deliberate about his retirement and how he sacrificed, which is also an important word, sacrifice, because that money can do things for you, but looking at what you want in the future, you may have to sacrifice. So he sacrificed certain things, and he was able to retire comfortably. Every now and then I see him with his wife. They are here, they are there, enjoying a comfortable retirement. And I'm told just after retirement, he bought himself a very nice Benz. This could be you, but dirty December is coming and you are planning to blow your money. So you have to repent. A bit of sacrifice is needed to be able to achieve these goals.
I think we'll move to Elik. Yeah, we'll move to Elikem now. Okay, you're saying something, Mimi. Okay, all right. So the last round of questions, and then we call it a day. So Elikem, can you share with us some of the opportunities you think people can take advantage of in terms of investment for retirement? Let's say that I mean you are managing funds of HNIs. You know what they invest in. So what are the recommendations you'd give to people that want to invest in financial markets, in addition to the tier 1 and then the tier 2? Yeah.
Okay, thank you, Edward. It's it's important that there's this saying, follow who know road, right? So I guess we could follow the people who have become wealthy. As Mimi was sharing her experience, I was also just remembering another client of mine, an agent, and his uniform in retirement is shorts. So whenever I send a package to his house and I want to make sure that he got it, I ask the delivery person, was he wearing shorts? Yes. Okay, then you went to the right house. Yeah, he's retiring very comfortably. Anyway, so how and such a person was an aggressive saver. It's true, not everyone can afford to do those extra things. Sometimes people are waiting till they become rich before they do these other investments. But I can tell you that this person was investing very aggressively. Yes, it varies, but let's see what this person was investing in. You can invest in the financial markets. Financial market sounds like a strange name, but it's really as simple as going to places like you go to your bank. These are formal, structured places where you can make investments. So the bank is a first point of call. I'm sure we all do transactions in the bank. The bank will offer you a fixed deposit. The bank can also buy government of Ghana treasury bills and treasury bonds on your behalf. Then we have brokers. Data Bank Brokerage is an example. We have IC Securities, Blackstar Advisors. There are other brokerage houses out there, GFX brokers. They can buy shares on your behalf. Then we have the mutual funds. We have standalone portfolios, customized investments by the fund managers like Data Bank Asset Management, where I am. So these are the formal structures. They are regulated by certain institutions. So when you go to the banks, we have the Bank of Ghana in the investment space, we have the Securities and Exchange Commission. A reason why you should consider these kind of investments is there is regulatory supervision. You could invest anywhere. You could go and buy an Uber and call it an investment. Perhaps this is what you are going to be doing Uber business. You've imported a few Toyota Vitz and Picantos. That would be what you are investing towards retirement. That comes with some risk. That comes with do you have sufficient oversight? Are you keeping good records? Maybe, maybe not. Drivers keeping records? Maybe, maybe not. They may tamper with the tracker. But when you come to the financial markets, the formal markets, you know that there's a regulator who is keeping an eye on things for you. People ask me, how are you doing? And I say, December is the calm before the storm, because when a quarter ends, I have so much reporting to do. I have to account for every CD that I invested or didn't invest, so you have some safety, you have a sense of safety in there. There's corporate governance, there are directors on mutual fund boards to make sure that things are going well. There are various corporate trustees, custodians keeping things separate. No one can just slip their hands into your money. So you have some safety there. And these markets are usually quite liquid. If you want to get out, you can just go and talk to the bank. I want to get out, and like Emefa mentioned in an illustration earlier, yes, they would not give you the full amount, but at least you get your money and you can go. But you know that there are some other investments that you can do, and it may take a while if you ever get your money. So yeah, there's that. So now specifically, I've mentioned that you can come to the financial markets. What exactly would you invest in when it comes to the financial markets? I think there are two main ways you can do it. Give your money to a fund manager or an instrument that you can trust. They have a good track record, and you can trust that they will take good decisions on your behalf. Or you can go it on your own and invest directly. I'll speak about the first one, which I would recommend. And from this point, this is not investment advice. I would strongly encourage that. Everyone has a different situation. So sit down with a licensed investment advisor and have a conversation that will suit your needs. But these are just pointers. We have mutual funds, all right? They are collective investment schemes, and they provide liquidity so you can get in and out as you want. There are boards to manage them, and there's a fund manager, a professional, someone like me with my suit and tie. I've taken it off because it's 8 p.m. Yeah, you have a professional whose job is just to wear these glasses and go through the financial statements with a fine-tooth comb. And we do this all day, every day. You can read financial statements, but would you be able to have that diligence to know what to look out for on your own? Maybe not. And let's be honest, you are busy doing something else. You are busy being an architect, being an entrepreneur, organizing events for people, wedding planning. You are busy doing your main thing. Give the money to the professional, pay them a small token, and let them take care of you. Then there are mutual funds. There are various types. I would encourage a balanced fund because there are some fixed income investments, the safer ones, and then there's also some shares in there. Shares can have potential to provide you higher return, though they come with some risk. You can lose all of your money sometimes, but there's that potential. So the balance helps you. There are also some equity funds you may consider, but I strongly recommend the balanced funds. Then also, beyond the mutual funds, you can also look at provident funds organized by some of these fund managers. So DataBank, Axis, Petra, they have certain schemes that operate like provident funds. I remember a client once called it a tier 4. But yeah, they are these structures, and some of them are licensed by the NPRA, National Pensions Regulatory Authority. So they come with certain tax benefits. Like the mutual funds I mentioned earlier, they don't pay taxes on interest and dividends. But you as an individual, if you go, there's an 8% withholding tax that's charged. So there are some of these benefits that you have by going to these institutions. Just to mention a few of these specific products, there's the Axis Pension Plan, there's the Petra Savings Booster. Axis also has a micro pensions, and that's suited for the informal sector. So you can look at them, or any financial institution. You can ask about these provident fund type of investments that they can do for you. That goes beyond your tier 1, 2, and 3. So yeah, those are the indirect ways that I would encourage you to consider. But let's say you are still a hard guy. Let's say you're a hard guy. You're a very sharp person. I meet people. I've been engaging with someone he's a footballer, and he's actually very intelligent. Pardon the cliche, but the stereotype. But I was quite intrigued by the kind of questions he's asking. Maybe you have time on your hands. You want to go at it on your own. All right, let's consider some. You want to balance the fact that you have a long time till you retire with the fact that you need the money to be there. The long-term horizon means you can weather the storms. Even if you lose some, you win some to make up for it. But you still want to make sure that the money is there when you retire, because people are saying, wishing you long life and prosperity. We are hoping that you stick around. So we want the money to be there when you need it. In this case, you can invest in Government of Ghana treasury bills, treasury bonds. I think these ones, we all know about them. With the Government of Ghana, it's considered the safest investment you can have. Worst case scenario, they print the money and give it to you. Worst case scenario. So there's the Government of Ghana. Then we have bank fixed deposits. Those are also safe. They provide moderate returns. Then you have corporate bonds. These are listed bonds on the stock exchange, the Ghana fixed income market. They provide some structure. They are highly regulated. They have to comply with many regulations, provide a lot of information. So you know that there's some oversight. And then there's shares. So you can buy some shares to invest in there. They can give you potential to earn higher return. But remember, those ones come with some risks. So bear that in mind and do some due diligence before you invest. Just that remember that if you are going directly, you have to monitor it yourself. When the interest payments come, don't be tempted to chop the money yourself. Don't be tempted to chop the money. Reinvest it, buy more shares, buy another fixed deposit, so that you can the money can keep growing and you can benefit from that compound return. Without that, if you keep just spending the money, inflation would eat away at all your money. So yeah, that's what I would advise to people who have some extra money that they can allocate to another layer of pension retirement planning. Thank you.
Okay. All right. Thank you so much, Elikem. We've spent a lot of time today. The internet was messing up in the beginning, so we've had to extend beyond our usual time. So we'll take one last question one last year response from Emefa. So Emefa, how can one track one's contribution for tier 1 and even for tier 2? Because I'm aware that SNIT does accept tier 2. Yeah, so how can one track one's contributions?
Okay, so let me clarify this. SNIT used to take tier 2 on behalf of tier 2 fund managers when they were not fully operational. The law became operational in 2010, but most tier 2 fund managers became fully operational around 2014, 2015. But because we have offices across the country, MPRA tasked us to take contributions on behalf of the tier 2 fund managers. So we used to, but we don't do that anymore. All those monies have been, anytime we take them, we pay them into the legacy account at Bank of Ghana. So I'm sure the tier 2 fund managers have sorted that on their own. So we don't take tier 2 funds anymore. Now, to track your contributions with SNIT, this is what you do. If you have gone through the SNIT biometric registration, then it means that we've got your details, your email address and telephone numbers and all that. So anytime we send quarterly statements, you would receive it. So this year we've sent 3 statements already. So every quarter, and our quarter is in 3 months. So the next quarter, that which is October, November, December, these statements will be sent in January. That aside, you could always sign up onto our web portal to check your statement as and when you so desire. You could also send an email to the contact center at snit.org.gh asking for your statement to be sent to you. It will be sent to you as well. You could walk into the SNIT office to print your statement. But as much as possible, because of COVID, we are trying to reduce the in-person interactions. So you could rather send us an email. But if you're not an email person, Or you're probably an email person, but you want a phone call, that's fine. Call the contact center on 0302 611 622 and we'll send your statement to you, or we'll go through the statement with you. So how many years have you worked, and where have you worked? So probably, let's say you've worked for 5 years, that is automatically 60 months. So where have you worked? Oh, I probably worked at SNIT, I work with Data Bank, I work with Access. So we look at all these places and then we calculate it for you, let you know that your contributions are up to date. But in the event you have issues, we ask you questions on whether or not you went on leave without pay, or you probably exited the job before you move into your next job. There were some lapses, maybe you stayed a month or two without a job before you move to the next one. Then we'll explain to you these are genuine gaps. That aside, you could get in touch with us on Instagram, Twitter, Facebook. Just look out for SNIT Ghana. Please don't post your details on the wall, on our walls, because there's a lot of secret data theft happening. Please inbox your details. And what are you inboxing to us? Your full name, your SNIT number, your telephone number. Why do we need the telephone number? We want to call you. We want to ask you a few questions to authenticate you that we are dealing with the right person. In this day and era, a lot can happen. So we want to do all these things. You could also send us a WhatsApp on 050,000 3050. Ask us to generate your statement and send to you, and we'll do that for you as well. I also know that the Tier 2 fund managers would usually send statements to their contributors. For my organization, for instance, our Tier 2 fund managers will send us contribution statements every 6 months, so twice a year. So then you are able to monitor your contributions. But you see, my problem with most of us is that these statements are sent to us. We don't even get the time to go through it. Oh, I asked for my SNIT statement. It was sent to me, that's all. Or you look through it and that's it. Please take your time and check to see the number of months you have worked or years you have worked. Does it reflect? Sometimes there are missing months you have no idea about. It's probably because your employer paid with wrong details. So at SNIT, we have what we call the suspense account. So then it's probably hanging in there, waiting for you to come in to complain, or anybody from that particular organization to come in to complain, so that we can rectify that. Or probably your employer didn't pay for you at all. You might not be in the know. So once you check all these things, we can rectify some of these difficulties. I must be quick to add at this juncture that if you are on this call and you haven't merged your SNIT number and your personal ID number on your Ghana card, what happens is that from January next year, 2022, SNIT will not be able to take contributions for you. Neither would you be able to print statements or do any kind of business with SNIT. Why? The Ghana card number, that's the personal ID number on your Ghana card, is replacing your SNIT number. And this process started in June. And so please, a lot of people have merged, but there are few people who are still trying to hold on to the last minute. Our deadline is 31st December. So if you haven't done that, please take opportunity of it today, because you're probably waiting to print your statement in January, because we're just going into Christmas, and because you have to go through and all that, you don't want to go into that process. Please merge the number. And also, when we print our statement, there's something we should be looking out for. Please check for the correct spelling of your names on your statement, because sometimes for you, the name you use at your end is not what we have. It's probably because you gave us the wrong spelling, or during capturing, we captured your name wrongly. These can be rectified. Again, when you take your pay slip from your employer's ends, your employer pays you. So they give you pay slip at the end of every month. When these pay slips are given you, please check for the correct quotation of your SNIT number. Your date of birth, year, month, and day, is embedded in your SNIT number. Once you don't see this, I'm sorry to say, you probably gave us your football age, or your employer is probably quoting your number wrongly. So please, as much as possible, let's check out our SNIT numbers and be sure that these numbers are correct. If they are not correct, raise issues either with your account or with SNIT. Most often, if it's with your pay slip, we ask that you raise it with your account officers. But if after raising it, it doesn't get resolved, you can get back to us. We also look through our data. Pull out your first registration form to see what you provided. It's interesting that in Ghana, people have a lot of date of birth. In fact, there are date of birth at our discotheque. Sometimes I see them and I'm like, really? What's happening at 1 minute? Somebody is born in this year, the next second they are born in that year, and they keep changing date of birth. But the system does not allow that. So please, let's be very mindful of the things we do. And I would also want to say that Sometimes, for most of us on the call, we probably have guaranteed student loan for people, or people have guaranteed student loan for us and we haven't paid. Please do the honorable thing and pay. And if you have taken student loan and it's hoping to use your contributions to offset your loan, it is not advisable. People have done that in the past. I don't encourage that. Why? It reduces the number of months you either two would have used for your benefit calculation. So let's say you probably have made 180 months and you are coming for retirement. And by the time you come, you probably have used 5 months or let's say 6 months or even 12 months to offset your student loan. Technically, you don't qualify for full pension. In fact, you don't even qualify for pension at all. You qualify for a lump sum. But for us as SNIT, as much as possible, what we desire for our contributors is for everybody to qualify for pension. We know that it's not realistic. Not everybody would qualify for pension. But as much as possible, let's have a greater population, a greater contribution population to earn pension. It helps a lot and it reduces old age poverty, extended family dependency, and all these things. So please, let's do the needful. Let's take our rights into our own hands. Let's protect ourselves. Some of us connive with our employers to underdeclare our salaries so that we can contribute on very little amount. Please, you would harm yourself. If you're on this call and you are doing any other side business, please be informed. The law allows you to make contributions from multiple sources of income. Once it's a genuine source, the law allows you to make contributions from those sources. So anybody who engages you, once you're doing something and you're going to take money as a form of reward, please give the person your SNIT number. Let them pay contributions for you. And don't rely on the SNIT benefit as a retirement plan. It is not a retirement plan. It just cushions you. All what is deducted from your salary is 5.5%. You are left with 94.5%. Please do something good out of it. Dedicate a great portion of that amount into investment if you don't have families now, and keep reducing the percentages as you start building your family so that when you are due for retirement, you can have a lot of money to take care of yourself. I engaged a group of people yesterday and I was telling them, retirement is like politics. It is only during politics that when you're going for a political office that people tell you stories about your ancestry that you never knew about. It is only in retirement you suffer medical situations that you've never heard about or things that you probably thought to be far from you, and you need money to take care of yourself. You need money to sustain yourself. So please, investment, we cannot overstress that everybody should try as much as possible to invest whilst they do the tier 1 and 2 and 3 alongside to cushion ourselves for retirement.
All right. Thank you so much, Emefa. I never knew that you could pay contributions for more than one source of income. So it's something that I've also learned today. Yeah, I never knew that. So just a few questions, actually just two. Number one, I just want you to clarify something. So this is to Emefa. You were talking about the lump sum that you receive as benefit for your contribution. I want to understand, maybe I didn't hear you clearly, but after you have received the first lump sum, do you receive like a monthly income from SNIT as part of your retirement benefit, or is it just one lump sum and that is it?
Okay, so we used to have that arrangement that was under the PNDC law 247, where we paid lump sum and monthly pensions. But the law that is in operation today, the Pensions Act 766, does not allow SNIT to pay lump sum. So tier 2 and tier 3 takes care of your lump sum. However, any contributor who makes less than 180 months of contributions, what happens is that your money is paid to you as a lump sum, because then you haven't qualified to earn pension. You haven't made the minimum number of months, which is 180 months or 15 years. If you make 14 years, you don't qualify for pension. So we pay you the entire money. So that is one of the conditions under which SNIT currently pays lump sum. Again, we pay another lump sum, but we call it past credit. This is for people who used to be contributors under the old law, PNDC law 247, because during that era, contribution was 17.5%. And currently, contribution is 18.5%. But what comes to SNIT out of the 18.5% is 13.5%. So technically, if you are deducting 13.5% from 17.5%, it means that there's a difference of 4%. So this difference of 4% annual salaries over the period of years people have worked before 1st January 2010, these monies, this 4% are still an investment, and we only pay to contributors when they come on retirement. So then we pay you that also as a lump sum. So all lump sums are just one-time payment. It is only when you qualify for full pension or reduced pension, that is when we pay you monthly money. So the money we pay you monthly is what is called the pension. Edward, please, are you okay?
Yeah, I'm very much okay now. Thank you for that.
Pleasure.
Yeah. Okay. I think that will be all for now. I'm just checking with the other team to see if there are any more questions. So a few seconds. Okay, yeah. So one more question. Can you use your SNIT contribution or your tier one as collateral for a loan? Example for mortgage. Yeah. Or any
Okay.
of the other contributions, maybe tier one and tier two. So maybe Mimi can answer for tier two and then for tier three, if you can use that as collateral. And then for tier one, that's for SNIT, if that can be used as collateral.
Okay, so for tier one, you're unable to use your contributions as a collateral.
Okay,
You're unable to do that. The law does not allow you to do that. But I think that some years past, I think about 4 or 5 years past, the then Minister of Labor and Employment Relations had some arrangements sort of wanting to use some, I think that tier 2 or 3, Mimi can better speak to that as a collateral, but I don't know how far that arrangement has been advanced. But for tier 1, it is not possible. You can't do that.
Okay, yeah. I think I remember something like that some time back, about a year or 2 years ago, where there was some kind of conversation around people being able to use their tier one and then other tiers as collateral. So maybe you can speak on that. Yeah.
Okay, I'm really struggling to hear you, but I think I got a little bit of the question you were asking. So under the tier 2 and tier 3, you are allowed to use your tier 2 and tier 3 as a collateral. With the tier 2, what happens is that you can't withdraw before you go on retirement. So what you do is you normally go to a mortgage company, and if they decide to accept it as a collateral, then you can use it. Remember that normally with mortgage companies, the house is normally a collateral. So this is not really in use. The tier 3 can also be used as a collateral. But because with the tier 3 you can withdraw, the structure is a bit different. So a lot of trustees have arrangements where you go to a mortgage company. Normally, the mortgage company would say make a down payment of 20% of the value of the loan or the property that you are purchasing, and then we'll give you financing on the rest of the 80. Now, if you have a tier 3 and a decent amount, what will happen is that they can take on all the 100%. It means that, yes, you'll be paying more in terms of monthly payments because you're paying on 100 and not 80%. But it also means that your provident fund is also working for you while you are also paying your mortgage. So that is one way of going about it. You can also withdraw your provident funds before the 10 years, because any withdrawal from the provident fund before 10 years affects 15% taxes. But if you're going to use it to pay a mortgage, then you can avoid paying taxes on that withdrawal you are making, which otherwise would have attracted taxes of 15%. But because you're using it to pay for your first mortgage, that cost is, or that tax is waived off. So these are some of the ways that you can benefit by using your tier 3 as a collateral. as I said, the tier 2 arrangement is there by law, but because the house is normally a collateral, unless a particular institution decides to take it, normally the house will be used as a collateral. So most of the advantage we see is from the tier 2.
Okay, all right, sure. Thank you very much, Mimi, Emefa, and then Elikem for the opportunity. For joining today's webinar and for sharing all the insights. Very much grateful. Also sorry for the initial issues with the internet when we started, but I think that a lot of people have learned from what has been shared today. And since the session will be on YouTube, people can always go back to listen and then still get the information. So thank you once again, and it's been my honor hosting you. And do have a wonderful evening. Thank you all. Thank you to the participants from Zoom and then those that were watching also on YouTube and Facebook. It's been nice having you around, and I hope that we take the insights that have been shared. I mean, I've personally learned a lot. I didn't know that you can pay contribution on different sources of income. That's something that is very good to know. And then the earlier you start planning for retirement, the better it is. And I'm just showing the things that I've learned. It's important to always think about where you would be staying. I mean, at the end of your working years, because one problem that people end up facing is that they have to end up using their retirement benefits to cater for their accommodation at a point, and that becomes very difficult. So thank you all, and it's been a pleasure. Good night.
Good night.
Good night.